favourable external environment of the past few years has taken a turn for the worse for India. Oil prices are on the rise and interest rates are rising in the US, raising the prospects of capital outflows from emerging markets. Now add to that the continuous threats of trade wars between the two largest economies. On the domestic front as well, the Indian rupee is in a free fall and the twin deficit concerns loom large. But on the brighter side, India's gross domestic product, or GDP, has seen the fastest growth in over 15 quarters in the first quarter. And with that 8.2% GDP growth, India remains one of the fastest growing economies in the world. So what lies in store for India from here on? To discuss that and more, we're joined by the Global Economist for Fitch Ratings, Brian Coulton. Mr. Coulton, welcome to the show and thank you very much for joining in. First, if you could start by telling us, how do you read the Indian macros at this point of time with the falling rupee and the rising crude oil prices? How does that augur for the Indian economy going into the next year?
Yeah, we were positively surprised by the Q2 GDP numbers. So that was a very strong number and shows that, in some ways India is more resilient than a lot of the other countries which have been caught up in this emerging market turmoil recently. Strong demographics here. We've had a recovery in the investment rate in the economy, which has been very important. We've had some very important reforms in the last few years with the GST, the opening up of FDI. So all those things bode well, but we don't see India being able to sustain 8.2% growth. We think growth will slow from here, partly because of the financial conditions have been tightening. The RBI has been raising rates faster than we expected.
What sort of slowdown are you expecting? I mean, 8.2 was very high. Of course, the favourable base effect did play a large role in that number. But from here on, what would be the growth drivers and what sort of a target? I think Fitch Ratings also came out with a review for the economy. What is your view?
We've got growth in the next couple of years easing back to sort of about 7.25% a year. That's the sort of number. So it would still place India as the fastest growing large economy, definitely. So very, very impressive numbers, no doubt about it. But not with an 8 handle.
All right. One of the big reasons of concern for the markets today is the free fall in the emerging market currencies, and that is on the back of a strengthening dollar. Now, the rupee was one of the best performing Asian currencies up until last year, but this year it's one of the worst. It's perhaps even worse than the Turkish lira. What do you make of that rupee fall? I mean, how much of it is driven by these global factors, and how much of it is really driven by domestic problems?
I think what's happened as the Fed have become more confident in raising rates and been signalling that to the market's adjusted its view of where we're going in global interest rates. There's been an increased focus by market players and investors on countries with imbalances, with current account deficits that need to be financed. And so even though India's deficit is probably smaller than it was back in the days of the taper tantrum, the fact that it has a deficit, has these twin deficits, as you mentioned, has brought it under the spotlight. Now, clearly, it's been much less aggressive than in Turkey, which not only has a much larger current account deficit, but a huge external funding requirement, a lot of short-term debt to roll over, very low reserve base. India is much stronger position than that, but the fact that it has a deficit means that when the market starts to worry about these things, it gets hit. And I think it's probably the change in global conditions which has been the key driver of the shift this year.
Yeah, but do you think the rupee depreciation in the long term could help us? When we're talking about the deficits to some extent, is the theory right to say that more expensive imports would perhaps curtail these habits, and it could actually benefit it over the long term, also as we become more competitive?
I think that probably is going to benefit the economy. I mean, the RBI seems to be taking a slightly more laissez-faire approach to the currency. They've let the rupee weaken. I don't think there are so many worries here as in some of the other emerging markets about how a weaker currency impacts balance sheets. That's a big concern in Turkey, for instance, and probably more of a concern in Indonesia actually than it is in India. So you can allow the currency to weaken, which doesn't necessarily lead to a big surge in exports. I mean, India's manufacturing export base isn't that large, so I don't think you get the boost to exports that say you will get in Turkey, but you will get that import compression along with the hike in interest rates. I think that's probably what we'll see going forward. You've got oil on the one hand, keeping the deficit large, but the domestic side, I think, will probably be starting to compress that deficit going forward.
But what would be that fair value of rupee, for instance? I mean, it almost touched 73, and then, of course, there was some intervention, and we've, in the last 1 year alone, we've lost almost 17%. At what value do you see the rupee stabilizing, say, by the end of the year?
Well, I think the last few years we've seen quite a substantial real appreciation of the rupee because we've had a new inflation regime. The government's been, the central bank has been trying to establish their credibility and have done so to a large extent, bringing inflation down. But through that process, the currency was actually quite stable relative to other currencies. I think now, India's inflation target is above US inflation. So over the long term, there is some natural tendency for the currency to depreciate. We think sort of early 70s is not a bad number in terms of where it's probably going to settle.
Okay, speaking of the current account deficit, the rupee, of course, has a large role to play. You were very close to breaching that 3% red line. Does that remain a big cause of concerns for investors as they look at India?
It partly depends on what it's funding. As I say, we have seen a slight recovery in the investment to GDP ratio in India. So the fact that the current account is being associated with a pickup in investment, we've had an increase in infrastructure investment. To that extent, it's less of a concern. I think maybe one thing that's gone with that, though, is that there's been a bit of a slight decline in FDI inflows over the last 12 months. And so if you look at the current account deficit and you strip out the portion of it that's financed by FDI inflows, we've actually seen a deterioration. And I think that is one of the things that's left India a little bit vulnerable, because that means that you need to attract debt flows, you need to attract portfolio flows, which are the precise elements of the capital flows that are being squeezed through quantitative easing. So I think that's going to be a crucial one to monitor going forward, that gap between the current account deficit and FDI.
But even with our GSEC, the 10-year government paper yields have breached 8% marks. Those are not attractive enough for more FDI inflows into India. You think more action is needed? I
think we're in the midst of a kind of global reset on interest rates. That's what's going on. For years, with the Fed rates on the floor, US Treasury yields very, very low. I wouldn't say this is necessarily something that applies to India, but emerging market central banks around the world have been able to get away with monetary policy settings that they haven't had to worry about a risk premium. Now we go back into the world where US investors can get pretty good returns at home on deposits and short-term credit assets, and so you're seeing a ratchet up in the required rate of return on fixed income assets globally, and don't see any relief on that front going forward. I think there's more to go on that.
All right. What about the fiscal front? We're also in an election year. The government has set a fiscal deficit target of 3.3% for this year. Does that look like it could be at a threat?
I think our view is that the targets, they have been overshot in the last year or two, and we think that will continue to be the case. Now, near term, that's probably going to help the growth picture, but medium term, the fiscal consolidation challenge is very much still there. That's been an issue for India since I was covering the economy much more closely 10, 12 years ago. It was the big issue. It's still the big issue today. Medium term, that's still a problem.
All right. The other big problem for our economy right now, of course, is the globally rising crude oil prices. Every day we're talking about, are we going to touch the $90 mark to a barrel, very, very soon. What exactly, and I think that is one of the reasons why you brought down the growth forecast for India compared to your earlier projections. What exactly will be the repercussions?
Well, obviously, it is a drag on the economy as a large net oil importer. It's increasing the cost base, and potentially could put some pressure on the public finances if we get subsidies kicking in to offset the effect on consumers. So it is an issue. Our medium-term view, though, is still that global oil prices will come back down. We see the US shale producers making leaps and bounds in terms of progress towards extracting oil in the US through fracking, such that our view of where the oil price will be globally in 3 years' time has not really changed. We still think that's below $60 a barrel, the marginal barrel. So some short-term volatility here, but I don't think this is going to be a permanent headwind for the Indian economy. I think this is an area where you might start to see some relief as we go into 2019.